Good afternoon, all traders at all levels. My name is Jeff Kilian. I am the founder, the trader, and the technical analyst for VectorTradersConsortium.com, VTCTraders.com. For those of you who don't know me, I've been in the business for almost 30 years. The inside technician about 8 years ago morphed into VTCTraders.com because we did recognize that the public needed a much higher level of education in order to be able to trade profitably. So today is 10/12/2023. We have an excellent presentation put together, and I want to talk all about red flags. Now, red flags can come in the form of non-trading opportunities, things that we want to stay away from, and setups that we want to highly consider to trade because the probabilities are in our favor. Everything that we trade has an 80% or greater probability of following through. It all begins with the end of day analysis. Now, since the inception of my trading many years ago, when I came across a fellow who worked at a major institution in Boston, he said, listen, if you're not, the only way this is going to work for you, Kilian, is if you're going to find a way to track and trade the deepest pockets. Otherwise, it's just never going to be the same. So my story is really long. I'm not going to get into the entire thing, but it was extremely painful. I had to go through an arduous process, which I wouldn't wish on anybody but an enemy, in order to make this happen for me and the people who've come through our system here. So what we're looking at here is finding and tracking and trading the deepest pockets. The market as we know it today is completely manipulated. We're talking about Blackrock, Vanguard, State Street, the offshore hedge funds, Cayman Islands, Singapore, coming in at a close second that can and do move prices from one level to another. They know exactly what we're doing. Our job, your job, is to be able to identify when and where they're going and to get on board, get on that train as fast as humanly possible. So today, we're going to look at ES, the S&P 500 Mini Futures, NCM 1223, and we're going to talk about a one market sell-off and one market turnaround, which is the most recent turnaround. What you're looking at is EOD analysis ending yesterday. So today's action is not on the chart yet. We're looking at a chart, again, of ES to begin with, and then we're going to move into YM because YM is my primary market. So anytime that you're going to trade anything, we need to begin somewhere. And where futures, the majority of the time, are leading, no matter what you're trading, stocks, index funds, ETFs, futures, YM, ES, NQ, doesn't matter. We have to begin somewhere. So we're going to start with the biggest futures market because it usually leads as well during the overnight session, right? To give you a good example of where prices might go on the open equity session when that kicks in at 9:30 a.m. Eastern Standard Time. So you're prepared for that if you're trading stocks or other instruments. Anybody who's not looking at ES, at least at a bare minimum, you're at a definite disadvantage, So let's begin with the most recent market sell-off that came in here. And this one we don't have enough time to cover, but within the last 60 days, we're looking at this action from here to here. So you're looking at an actual chart within a workspace of mine, say 7 or 8 different charts, with, in this case, 2 indicators in the subgraph below. Now, this is an exception. I usually use only one. I do not want a lot of indicators on my charts because it takes away from the ability to analyze the way that you need to do it in order to get it right. So for this market sell-off here, we have to begin with divergence analysis, and it is paramount in identifying pent-up selling or buying pressure that has not yet taken place in the form of the future directional price movement. So this goes back to the very basics. A proficient trader needs to understand the mechanics of what's going on behind the prices. The price action is one thing, and it is important, and the volume is second in importance at various market turning points. The dry up, then the spike to come in for the sell-off, the stabilization of the volume here, and then the additional volume come in with the indicator turning back around in order to drive the prices back up for these 3 days. So you're looking to find out again what's behind the prices and what are the real probabilities of the future directional price movement, because you have to have a bias for the market every day, and you have to absolutely positively have to understand that there are windows available in trading. This kind of action here is extremely difficult to trade, sideways moving market. This here, we're looking for this type of price action, uniformity, right, in the price action itself, in order to have a free and clear move on the way down the path of least resistance to land here, possibly here. Okay, so let's look at the stair step up and then the subsequent move back down. Quickly here, here's the SMI, the stochastics momentum indicator, which I believe in my arsenal is the only price-based indicator that I need. Okay, stochastics from George, way back in the day, but now with a momentum line attached, the crossover from above to below after the negative divergence as compared to the prices. So here we have a major incline in the distance between a lower price, a higher price, and then a higher indicator level and a lower indicator level, signaling a definite intermediate term negative divergence. Okay, on the price section itself, here is the area where the prices fell off after the negative divergence. The crossover is here, and there you go. So these are the kind of things you want to look at, along with the volume picking up here at this juncture, right here, in order to say, okay, these are definitely sells that have come in here. And we can be clear, based on what we're looking at right now, that we have a real opportunity set up to go short. Here's the gap down right here, from here to here, okay? And you're talking about 8.2. And then the corresponding additional volume kicks in right there, and here, and here, and here. These are 3 sells that came in after the pivot point high was established for the blow-off. Many traders know about this, but we want to look for the dry up before the sell volume comes in to be sure when we have a negative divergence on the price action itself that we have a real opportunity, and need to start paying a lot of attention to this. So going through the motions here now a little quicker so that I've explained myself on divergence analysis, volume, and the crossover here on the SMI, the only price-based indicator I use. Let's get right into the MFI. Money flow index is short-term smart money tracker. And here we are. Same trend line application. That's static. That stays the same. But the vowels on the indicator are different. And obviously, we have a very steep negative divergence as compared to these prices here moving up. So here's your gap down right here. But long before that, the indicator is already going south right here. Let's back it up one more day. There you go. This is a clear indication of the setup, which provided the gap down in order to consider going short. So now we have short-term money who's out of the market, has gone short before the prices have followed through in a big way. Confirmation. Right here, checking money flow. We are flat on the CO, trend line static, so we don't have exactly what we want in the form of a strong negative divergence as compared to the prices, but it still exists. In order for this to be valid, we have to be at 0 from left to right, Y and the X axis, beginning and the ending, based on these peaks. So there you have it. I mean, you could also do this if you wanted to. You could fly this in here and look for the break here, right, before the prices followed through. That's another clue. Okay, so there's 3 different indicators, and this is long-term money, 21 period versus 14 on MFI, to tell you that this is now becoming a high probability market turning point, and the deepest pockets are behind this because they're gearing up to go short long before The public knows it. So behind all this, behind the scenes, back in the day, with the inside technician, what's going on behind the market is now becoming clearer and clearer and clearer. Okay? In the correct order. Okay, let's do the MACD here. There you have another negative divergence right here. And I do have a singular indicator for the SMI below the prices. But when I'm doing my end of day analysis, I want that SMI and the volume both in the subgraphs below. And in the case, again, it's a single indicator. So there we have that. Okay. So now our conclusion is within the next few days here, we really need to be paying attention and get geared up to go short. Now, in this case, a more experienced trader would definitely be looking to increase your contract sizing, right? If your minimum is 3, let's go to 5, let's go to 6. If the move follows through on increased volume the subsequent day, the day after, the break and the prices trade to the downside, well, then maybe we're going to trade more. This on its own is a great, great conclusion because on our end, we have ways that we train traders on how to put a numbered stamp on the strength of the short. Are we at net neutral like here? Are we at short level 6? Are we at short level 7? Are we at short level 8? Where are we? And that constitutes the majority of a decision coupled with the real-time trade setups based on the 15-minute charts, the 5-minute charts, and the 1-minute chart for execution based on our levels that we've laid out. What kind of contract sizing are we going to trade based on where we're at right now in real time? So sticking to the plan, the end of day analysis is where it all begins. Now that we've finished in part the analysis on ES, where my primary is YM, and sometimes I'll go to NQ. Okay, I want to get out of this, and I want to go see if I have similarities on YM. Let's go back to the beginning, go through the proper sequence of my charts here, and here I am. Well, guess what? I have another negative divergence on YM and CM 1223 here, same near contract month. Okay, it's evident on the stochastics momentum indicator right here. And there's your volume, and here's the additional volume coming in right here. I'll size it up here for the sell, right? So where the S&P 500 mini futures is the big brother market, the little brother is going to follow. Maybe not exactly the same way, but it will follow in the same direction that the S&P is moving, ES is moving, because these markets run in parallel. They run in tandem. Sometimes they're a little off, but most of the time, greater than 90% of the time, they are moving in the same direction and with pretty much the same volatility, the measure of market variability and the range of the bars and the size of the contracts, the contract sizing that's coming in. So we have a confirmation here. Now we have more case evidence in order to gear up and trade short in a short period of time. So it's becoming more clear. Now let's get into MFI, excuse me. Well, you didn't get a negative divergence, but you got a direct cross right here, right? This is the earliest warning the MFI gave you and completely tanked. Look at it. Long before the prices ever started to trade down. Look at this, look at this, look at this, look at this. How much far back can the rubber band, stretch before it has to snap? It's just a matter of time. We're looking for that additional volume to come in, right? Down again, down again. There you go. Here's the break of this level right here with this bar based on 815. And straight down and straight down and straight down. Now, once again, traders, if you get your head around this for just a moment, please stop and think. This could just as well be a 15-minute chart. It's price action. The indicators compared to the price action above, right? Could be. Could just as well be looking at a 5-minute chart, right? Absolutely. when you're getting into real time. Okay. So here we are again, a different way, but an additional very strong confirmation that the market should be selling off. What else? Let's get into checking money flow. Here's your negative divergence now from here to here instead of from here to here like it was in the S. And there you go. There's the sell-off right after the negative divergence compared to the prices. Okay. And then we have the MACD crossover here. You didn't get a negative divergence, but it never looked back. Never after that. Okay. Okay. What else? Take an oscillator here. Strong, extremely strong negative divergence. No computation relative to the to a different formula to be able to analyze accumulation and distribution. Excellent indicator. Okay. So now let's talk about levels. Because if you don't know how to lay out these levels, that's a major red flag as well. A major, major red flag. The majority of traders, with all due respect, they have a really good idea about where to get in on a trade, but they're not sure about exactly where to get out. And what we want to do is we want to get out at a predetermined level. And in real time, that becomes a predetermined level on the downside for the short, known as PPT number 1, price profit target number 1. It's usually the fastest, the cleanest, the most profitable move that a trader could get in order to be able to capitalize on that. So let's get into this chart here and we'll run it down. Okay, this is a VTC line labels indicator. When it's above prices, it clearly spells resistance. When it's below prices, it spells support automatically. So you don't have to draw a lot of lines. At this point here, this is where, based on the open or close in the most recent action, where the prices were. So we were looking for this break below this low right here in order to go short on this day. And there was a move. The next day, it shakes this level out again and then goes south, south, flat, flat, south, another flat day, and south to finish it up. Meanwhile, all the time, the indicators that you just saw are clearly dictating what the higher probabilities are here. Okay? So there's your break for the short on the end of day analysis confirmations. The stair step up, the interlock bars on the way up create the path of least resistance on the way down. Because you have some volume here, but on a sell-off, prices will usually trade down faster because of the panic for the sell-off or the drive of the move that Blackrock and like-minded institutions have created. So where's my target on the downside for the first leg of this move? It's here because that was created on the way up as a free and clear. We call for the way down, a free and clear move, bang, right here. The next is right here on that open, right here on this open, right here, and then all the way down to here. And where did the prices go? Right there. That's it. So this is how you lay out your end of day targets and in real time as well in order to be able to judge and realize where exactly you need to get out and then, more than likely go flat because you have more congestion here at this point. And on, how do I say, I'm not a level with a double bottom here, so that's and almost a triple bottom here. That's a little iffy. I'd go with price profit target, end of day level 1, 2, possibly 3, and then I think about getting out because this day opened up and then traded right down to here. So that would be it. I'm looking at 1, 2, 3, 4 days, a window of 4 days. That's more than enough to make the lion's share of the money. Don't get greedy. When things get flat, the indicators go north after this. Don't do anything. Get out. Find something else to do. Okay? All right. So let's get into now the long move that's taking place here afterwards. And I'm going to do this quick and dirty from scratch because I don't have anything laid out because I want you to see exactly how I knew that the prices were going to turn back around to the upside with a high probability. So real quick and dirty here, back to the S&P where it's got to start, right? And here we are. Okay. Now, we don't have time to go pretty everything up and get the charts in order because we're not going to spend a lot of time on this because we're on a time constraint. We have probably 10 minutes left max. So here you have the MACD crossover. And this is not in the correct order, but it's quick and dirty. And at this point right here, right, what we have after this day, right, is you have the crossover in infancy from above to below. But in my case here, what I'm looking for at a bare minimum is an uptick out of the green line, the faster, right, of the two, in order to consider going long on a market turnaround to the upside. I need that. I can't have this. I can't have flat. I need a minor uptick in order to do that. So that's what you had when the market turned back around here. Here, when we look at this here, okay, let's quick and dirty this in. Here's a trend line connection from here to here. Higher price, lower price. F2 again, lower indicator, higher indicator level right here. Say that. Now we have pent up buying pressure here at this point, right? And the prices should continue to move up. In fact, it even happened before that up day. So they knew that this was going to be an established floor, and this was in process before the prices traded up. Okay, here, trend line the same. You can copy and paste this in, it's okay. And here, there you go. And that's where you were, right here, before these prices ever traded up. Chaikin oscillator. Again, money flow index here, short-term money tracker. Same thing. Here we go, and here. Okay, so in this case, we don't have a positive divergence as compared to this, but we do have a break again here. And we also have, for those of you who've never seen this before, we have a break above this level right here with the indicators internal, free and clear, all the way back up to here, which relates to about this price point here or here. Interesting. The value of the indicators leading the price movement is worth their weight in gold. It's just a matter of learning how to interpret these. And I don't mean just learn an indicator. I mean go to bed with it as if it was the only thing that you had to trade off of. And you had to get it right, right? That's the way to approach this. Okay. So here in this case, price-based indicator, and the beat goes on and on and on, right? Excuse me. Here we go. And there you have it. A crossover from below to above, and we use a special negative 50 line here, so we don't come in late at 20 or 30 like a lot of traders. We want to catch that trend at the exact same time that it's starting to trend upward to capitalize on the explosive move. Remember, 2, 3, 5, 7 days on an open market when the market is moving quick, but 2, 3, 5 days is more than enough to make enough money to be satisfied. Okay. What else? Did we miss anything else? No. Okay, so here's the new level that's been formed here, and here we are. Okay, our price profit targets are both here and then here and then here, right? Did prices on ES get up close to 44, 47 today? You'd have to check. Possibly. Run it. Okay. Here's your point of control where the prices, okay, because the downside volume, you're getting up to upside resistance, that's superior upside resistance. So I wouldn't be surprised if prices tapped out around this level because the first third of this bar is where the majority of the institutional selling by Blackrock and others came in order to continue to drive these prices down after this break here. Okay, let's finish it up with the confirmation. Same thing, a little different. Same process, okay? And here we are. A little different. Same idea. Okay. There you have it, right there. And there's your cross before the prices followed through to the upside. 1, 2, 3 days right there. Okay, let's just copy and paste this in. Okay, we didn't get it on the MACD, but we did get the uptick right here, and that's all you need. When you cross from below to above the signal line, the trend is increasing in strength to the upside. But again, you don't need it. You need just a minor uptick out of this in order to be able to have clearance out of the MACD itself. Okay. Now in this case here, get this back in here. You didn't have it. You didn't have a positive divergence. But again, using what you need in order to make your decisions, you've got to break right here. And if you want to size it down, okay, you can take this trend line and move it over to this peak. So there you are, right there. Copy me? So the earliest warning was actually this trend line violation right here, right there. Also, opposite, but not inversely proportional, would be the break of the internal level out of the MFI right there at this inside fold right there, with a free and clear from here to there. Copy that internally. So prices have free and clear, so some of the indicator formations as well, in order to be able to help give you a better situation. Okay. We already went through this. Okay, here's your positive divergence. Again, we saw it in the volume, the subgraph below. Here's the checking money flow long term. Same situation. You don't have an official, right? Positive divergence, but look at the breaks. Let's use the fanning technique, right? Here is one right there. Here's another right here. There you go, right there. From here to here, based on the most recent action, and then back to here. Okay. And there you have the up moves before price started to take off out of this indicator in isolation. So, looking at the price action itself here, let's get rid of this. Very similar, but not the same. Okay, there's your VTC line labels that changes from support to resistance. There's your bottom. Similar, but not the same as yes. And there's your, let's get rid of that. Okay, there's PPT number 1, and day level number 2, and right here. See, so this is very similar, but not the same. So you already have all these levels laid out. And if you have a real-time data feed, these are going to be updated in real time. Although it's a daily chart, it's updated in real time. So this is where we want to be. Now, before we finish, I have a few very important things to say about the proper procedure in order to become a successful trader, and yes, a highly profitable trader. If there's one thing outside of everything that we've gone through so far that I need to make a home run with, please listen to me carefully, very carefully. You don't have to prove a damn thing to the market. You don't have to trade every day. If you're a scalper, that's a different story. That's for a true professional that's been in the business a long time. That is not the majority of people. Don't think you're going to walk in to the Coliseum, compete against people, yeah, like me, institutional people who have a lot of water under the bridge, and you're going to be profitable the majority of the time, because I'm sorry, The odds of that happening are very, very slim, very slim. So your greatest positional advantage as a trader, and now hopefully becoming a professional, is waiting on the sidelines, right? Until a high probability market turning point shows up and the high probability trades in real time. And again, you could be looking at a chart of any stock right here and create a workspace of all these indicators for your stocks. Look at the group that it's assigned to, the subgroup, and then the sectors. If you're doing that, I did that years ago, and I made a lot of money. But now I'm trading futures all the time because I don't want the overnight risk. Some people can deal with that, okay? But I'm not at a point in my life, and now that I'm a little bit older, that I want to deal with that and sometimes wake up, and I'm down 30% of what I've made because the market got down, right? Be logical. So again, the most important thing is trade only the true high probability market turning points that have an 80% chance or greater of following through, like we just showed on the short and the long so far this week. You don't have to participate. Let the market come to you. Here's the deal. Let the market come to you and prove to you that it's worth your emotional and monetary capital, because your monetary capital is one thing, and yeah, it's crucial. But your emotional capital, to me, is even more important, because if you do the wrong thing over and over again, when the real high probability market turning point comes and the setup's in real time, you're not going to take it, or you're not going to be able to think clearly enough to get it right. So this is my heartfelt advice. And you can do whatever you want to do. It's your money, it's your time, it's your life. But for me, we have to stick by the rules. We have to. So that pretty much concludes our presentation for today. We don't have time for questions. I'm sorry, because everybody's time is valuable, and we're about 5 minutes over. So I hope you've enjoyed this presentation. We said we were going to talk about red flags. We did. We talked about divergence. We did. And we talked about how to lay out the price levels ahead of time, so you know where you're going to get in and where you're going to get out ahead of time. Jeff Kilian for VTCtraders.com. In the chat area, we'll leave this open for a while. Our links to the website. There's a few handouts there for you to take home with you, and a link to our professional trading course, the exit market timing course, which is all of this for 7 sessions on steroids. Okay, wherever you are today across the globe, have a great morning, a great night, a great day, and we'll see you on the next presentation. Yeah, we're going to leave this room open for about 10 minutes, but we are stopping the recording now.